Welcome to the Deep Dive. Today, we're really digging into the minds of some legendary stock market figures.
Yeah, forgetting the daily noise for a bit. We're looking at the long game, the big strategies.
Exactly. We're using insights, mostly from the book How Legendary Traders Made Millions, to, understand what made traders like Jesse Livermore, Bernard Baruch, Gerald Loeb, William O'Neill, Darvas, Wyckoff, even Jim Roppel.
That's quite a span of history there, over a century of market action.
Right. And our mission, basically, is to pull out those timeless nuggets. How do they spot chances, ride out the storms, and, well, make those incredible gains? Let's get into it.
Okay, so the first thing that really stands out across all these guys, different eras, is this idea of market cycles. It just keeps coming up.
Like history repeating itself.
Pretty much.
Right.
Jesse Livermore said it, something like, recurring patterns happen because stocks are driven by humans, and human nature doesn't change. It's a powerful idea.
It really is.
Yeah.
And it's not just ancient history, is it? O'Neill said the same thing about the dot-com bubble, right?
Exactly. William O'Neill looked back at, I think it was 1998 to 2002, and said, look, this cycle was just like the ones before. The losses might feel huge, maybe extraordinary, but the mistakes people made. Same old story.
Wow. So the tech boom and bust wasn't actually that new in principle.
No. The book draws lines straight back to the speculation in the 1920s, or even earlier with railroads, different stocks, same human emotions, greed, fear, that whole cycle.
So knowing these cycles exist, how did these traders actually use that knowledge? What were the core principles they stuck to?
Well, it wasn't about predicting the exact top or bottom. It was more about being prepared, understanding the historical context, helped them manage risk, recognize shifts. It's a practical tool, really.
Makes sense. And one thing the book hammers home is rules, discipline. Seems even the best could fall apart if they ignore their own basic rules.
Oh, absolutely. That's maybe the most consistent theme, sticking to your rules, especially when things get emotional.
So what were some of those key rules or strategies?
Okay, number one probably was learning from mistakes. And crucially, cutting your losses fast.
The classic, cut your losses short.
Yes, but they lived it. They saw it as preserving capital. You can't win the war if you lose all your soldiers in the first battle, right?
Yeah.
Capital preservation was everything.
You see that with Bernard Baruch early on. He made mistakes, but learned to take profits and wait for confirmation. That 1897 move, cashing out before a drop, that was learned discipline.
Definitely. And Gerald Loeb, he admitted losing big early on because he fought the trend, didn't do his own research. Later, protecting profits became his mantra.
So it's a recurring theme, Wyckoff too, right?
Yeah.
His focus on loss cutting helped his clients make significant net profits over time.
Yes. And even more recently, Jim Roppel talks about taking small losses, testing the waters, and just cutting things that aren't working without getting, attached.
Right, take the small hit, move on. Okay, so besides cutting losses, what else? Following the trend seems huge.
Oh, massively. Livermore was famous for it. Wyckoff, too, his success in 1915-16 was all about trading with the trend.
Loeb learned that the hard way, too, didn't he? Not fighting the tape.
Yep. And O'Neill's whole Can Slim system is built around buying strong stocks in confirmed uptrends. Don't fight the market's main direction. It's just easier to swim with the current.
But not just any stock moving up, right? They focused on leaders.
Exactly. They looked for fundamentally strong companies, often ones with new products or services everyone was starting to use, the real market leaders.
And those leaders change, don't they, from cycle to cycle?
They absolutely do. O'Neill pointed out how often the new leaders are recent IPOs, young, innovative companies capturing the market's imagination and investment.
Okay, and the book mentioned something called pyramiding. How did that fit in? Sounds risky.
It can be, if not done right, but basically it means adding to a position that's already working. You've got a winner, it keeps going up, so you carefully add more shares.
So you're pressing your winners, not just letting them ride.
Right. It's a way to maximize gains on your best ideas. Wyckoff used it. It's a treat many top traders share, but it needs real discipline and risk management. You don't just blindly pile in.
Got it. Now, something else that seems crucial is observation, timing. They seem to have a real feel for the market's pulse.
Definitely. Think about Wyckoff and Baruch seeing the top in railroads way back in 1901, or Wyckoff's get bullish call in 1904 after a panic. That's keen observation.
And Livermore spotting the top in Union Pacific in 1906 just by watching how the leading stocks behaved. That's impressive.
It is. They weren't just reacting to news. They were reading the tape, as they'd say. Price action, volume. O'Neill's focus on volume, like his follow-through days, is a modern version of that. High volume on a breakout signals real conviction.
But markets aren't always clear, are they? They chop around. Did these traders just sit tight then?
Not always. Flexibility was key. Baruch sold holdings when the market went sideways in 1902, just stepped aside.
When Loeb adapted too, right? Though he sometimes missed a beat, like in that 1926 correction.
Yeah, he learned to trade less in and out as he managed more money, but even he admitted to being slow to react sometimes. But then look at O'Neill in 62, market changed. He started shorting. Adaptability.
Loeb in the 30s is a great example too. Tough market, but he found ways to profit quick trades, exploring foreign markets even.
That's it. You can't be rigid. The market environment changes, sometimes drastically. You have to be willing to change your approach, even your whole outlook, based on the evidence.
Which ties into another point, ignoring opinions, focusing on the facts.
Oh, huge. That Livermore quote at the start about opinions being worthless, so true in trading.
Like Jack Dreyfus in 37. His firm is telling him one thing, but his charts say danger, so he goes 100% cash. Gutsy.
Totally. And Darvas, developing his whole box theory, basically tuning out everything except the price action of his stocks. He learned to trust his own system, not the noise.
It's hard, though. All that chatter, the news, expert calls.
It is. It requires immense discipline. And that leads to emotional control, doesn't it? The book mentions how tough even 1929 was, resisting that final crazy blow-off top.
Yeah, avoiding the hysteria. Easier said than done, I bet.
Definitely. Fear and greed are powerful forces. Managing your own emotions is maybe the hardest part of trading, but absolutely essential. These guys weren't robots, but they learned to act based on their rules, not their feelings.
And underlying all of this, it seems they were just constant students of the market.
Always learning. Baruch digging into fundamentals. Wyckoff intensely studying market action, O'Neill learning from Livermore's history, Darvas becoming an avid student after some early success.
Even Roppel, right.
Yeah.
Analyzing his trades, getting mentorship.
Oh, absolutely. Post-trade analysis, learning what worked, what didn't, why. It's a continuous improvement cycle. The market's always teaching, if you're willing to learn.
Okay, let's maybe walk through some of those historical periods and see these principles in action, like the early 1900s.
Right. You had Baruch cutting his teeth, making those early mistakes, but learning discipline. Wyckoff was already making insightful calls, like during the Northern Pacific Corner. Then the 1903 panic, followed by a strong rebound classic cycle action.
Then 1906, 1909, Livermore really makes a name for himself, right? Calling the top with Union Pacific.
Yep, using that leading stock principle. Then came the panic of 1907, a sharp break, testing everyone, followed again by a recovery. See the pattern.
Definitely. What about the 1910s? Seemed choppier.
Yeah, the market was trickier for a bit. Wyckoff adapted by focusing on emerging leading industries, like chain stores and mail order. Then World War I hit, creating huge moves in specific stocks, Bethlehem Steel, GM.
And Wyckoff was trading with the trend there, pyramiding.
Exactly, following the strength. But he also knew when to step back. The book mentions him staying out during a particularly choppy period in 1918, flexibility again.
Then the Roaring Twenties. Loeb enters the picture more.
Right. Loeb is learning his early painful lessons. Then comes the huge new era bull market. Wyckoff was apparently giving very profitable advice then.
But Loeb stumbled in 26.
Yeah, didn't act quickly enough on a correction. A reminder that even experienced traders slip. Baruch also had a famous miss trying to short GM and getting squeezed. Nobody's perfect.
And then the lead up to 29. The euphoria must have been intense.
Off the charts. But Livermore, Baruch, Loeb, they all apparently saw warning signs. Leading stocks starting to falter, speculative excess. Loeb later talked about losing his sense of proportion. Emotional control tested to the limit.
Then the crash in the 30s. Brutal period.
Incredibly tough. There was that initial sharp rally off the lows in 1930, which fooled many, then a devastating decline into 32. But Loeb showed his adaptability here, making quick trades, keeping losses small, even exploring foreign markets. He wrote his famous book then, too, The Battle for Investment Survival.
And the market did eventually bottom in 32.
Yeah, followed by a strong rally in 33. But then things got choppy again. You had the 37-38 bear market. That's when Dreyfus famously went to cash based on his charts. And then, of course, the market reacting to the start of World War II in 39.
Moving into the 40s, Loeb was cautious.
Very cautious early on, but apparently predicted the rally that started. Then, post-war, inflation became a worry. Interestingly, even with all his experience, Loeb hesitated during a downturn in 1946. Shows you never fully conquer the emotions.
The 50s saw the rise of institutions, right? And Darvas came on the scene.
Yeah, more professional money management. Dreyfus had another good call in 57, heating his charts again. And then Nicolas Darvas, the dancer, developed his box theory. A real techno-fundamental approach.
He had some early stumbles, though. Lorillard.
He did. Lost money initially, but he refined his system, learned to ignore the noise, and then had huge success with stocks like Diners Club and eventually Lorillard again, ironically. By 59, some stocks were in a climax run and margin requirements were rising classic late-stage signs.
Then the go-go 60s. More speculation.
Definitely. Lots of speculative new issues. But then came the sharp 1962 market break, the Kennedy slide. Significantly, both Darvas and O'Neill were apparently out of the market, having seen warning signs. Discipline paid off.
And the recovery was led by
More solid investment-grade stocks initially. O'Neill had a big win with Chrysler then. The mid-60s, 63 to 66, were strong, but again, you saw leaders like Boeing and Motorola top out, signaling caution before the 66 correction.
Okay, the 70s. Stagflation. Oil shocks.
Yeah.
Rough decade for buy and hold.
Very rough. The market peaked around 72, then the severe 73-74 bear market hit, amplified by the oil crisis. It was deep and painful.
But it bottomed eventually.
Yes, late 74 into 75, in a pattern similar to 1907-08, and O'Neill, again applying his principles, apparently pyramided Chrysler successfully during the recovery in 75.
So even in tough decades, the methods worked if applied correctly.
Seems so. The late 70s saw rallies, but also corrections amid stagflation and Fed actions. Volatility was high.
Into the 80s, things started looking up.
Big time, especially the early 80s. The NASDAQ led the way. O'Neill had huge winners like Pick and Save and Price Company, though oil stocks cratered after their big run.
O'Neill even took out an ad in 82.
Yeah, a full-page ad predicting a recovery based on his market studies. And sure enough, the market bottomed mid-year and took off. Classic O'Neill trusting his analysis.
But not always smooth sailing. 83, 84.
No, 83 saw divergence, market narrowed. 84 had a correction on rising rates. Then 85, 86 were very strong. Think Genentech, Reebok. O'Neill locked in big profits.
And then 87.
Market diverged again, leaders weakened. O'Neill saw the signs and apparently avoided the worst of the October crash. Discipline and observation paying off hugely. And this is when Jim Roppel starts his journey, learning about risk firsthand.
The 90s started slow, but then take off.
Yeah, early 90s recession, then recovery. Roppel made mistakes early on, learning Loeb's and O'Neill's methods. Then from 95, it was a powerful bull market. Roppel started getting his stride, citing iOmega as an early success using learned strategies.
Even with bumps like 97's Asian crisis.
Market dipped but rebounded fast. Then came the late 90s frenzy. Home Depot, Yahoo. Roppel mentioned big wins in eBay and America Online, riding that internet wave using disciplined methods.
Until the music stopped in 2000.
Exactly. The dot-com bubble burst. NASDAQ showed clear topping signals. Stocks like Qualcomm crashed spectacularly. A brutal bear market from 2000 to 2002, very reminiscent of the early 30s in some ways.
How did someone like Roppel handle that?
He talked about learning to navigate it, even finding shorts, and crucially, identifying emerging leaders even during the downturn, like eBay holding up relatively well. Then the market bottomed in late 02, early 03, and he was finding new leaders like SanDisk for the next cycle.
Wow, it really brings it all together, seeing those principles applied across so many different market conditions.
It really does. You've got the cycles, the absolute need for rules, cutting losses, following the trend, finding the real leaders, adding to winners, timing, flexibility, ignoring noise, controlling emotions, and just constantly learning.
It's like a complete toolkit, honed over decades by different masters.
Yeah, and what's amazing is how consistent those core ideas are. The stocks change, the technology changes, the news changes. But the patterns driven by human behavior and the strategies to navigate them seem remarkably timeless. History might not repeat exactly, but as the book suggests, it sure does rhyme.
So the final thought for our listeners, maybe it's about taking these historical lessons, this century of wisdom, and thinking about how they apply now.
Exactly. How can understanding Baruch's discipline, Livermore's trend following, O'Neill's leadership focus, or Loeb's adaptability inform how you look at today's market? It's enduring stuff.
Definitely something to chew on. This has been fantastic, really insightful. Thanks for walking us through it.
My pleasure. Always fascinating to revisit these legends.
And thanks to all of you for joining us on the deep dive. We hope this look back gives you valuable perspective for looking forward. See you next time.